And joining us now to discuss the current PE ratio of the markets is Aaron Kennon, Chief Executive Officer at Clear Harbor Asset Management. Aaron, great to have you back on the show.
Thanks for having me, Michelle.
So, Aaron, let's start off with today's market movement. We saw a slide back, a pullback from yesterday's highs. What's your take? Just a minor pullback today?
Sure. I mean, we think that ultimately over the medium to long term, the U.S. equity market will be driven by earnings going forward, much more so than, as you mentioned, price to earning ratio increases or multiple expansion, as they call it. Last year was really a historical anomaly where you had significantly high return on market investments, with the market up well over 30%, the S&P 500. But 75% of that return came from PE multiple expansion. We think this year is going to be very different.
Break that down for me. What do you mean by PE multiple expansion?
Sure. So the price to earnings multiple that the entire S&P 500 was trading at the beginning of the year relative to the end of the year expanded so significantly that a great deal, 75% of the total return of the S&P 500 last year actually just came out of that multiple expansion rather than where it historically originates from, which is earnings growth. We think this year is going to be quite different. It's going to be earnings growth driven.
So you're saying that the actual bottom line earnings that companies were reporting was not in line with the high valuation of their share prices?
Yes, I mean, at some important level, that's correct. Clearly, the macro environment in the United States has improved, and so the future earnings potential of these companies clearly has been markedly improved over the course of the last couple of years, and the market's willing to give credit for that with a higher multiple.
So from a historical perspective, where are we now?
We are actually at about an average from a price to earnings multiple perspective. However, we're at an area where market volatility is still historically quite low. What we think is going to change this year is we're going to see an increase in individual stocks, in sectors within the stock market, just finally witnessing higher volatility. We're going to see more dispersion. It's going to be a market for active stock pickers, perhaps a bit more than for those who invest through the passive market.
Okay, so rather than seeing the entire index or an exchange-traded fund like the S&P 500 rise up, you're going to see more selective stock picking.
Absolutely.
So which sectors are you seeing most growth in then?
Well, where you see huge dispersion in valuation right now, for example, is in technology, where a company like Apple Computer is trading below the overall market, trading at about a 13 times multiple, whereas other technology companies, particularly internet-based companies, are trading at extraordinarily high multiples. So there's sort of diamonds in the rough there that we think are quite attractive.
You think Apple is a diamond in the rough?
Well, Apple's not certainly a company that is unknown. But it's a company where we think it still has a significant amount of momentum to the upside.
Well, let's talk about these so-called momentum stocks. The NASDAQ is down about 1.8% year to date. The S&P up 2%. The Dow more or less flat so far. But the NASDAQ has been hard hit because of a sell-off in these so-called momentum stocks, more along the lines of the social media stocks. So I want you to elaborate on your differentiation between the traditional tech stocks and the social media stocks.
Sure. So a company like Apple is clearly more traditional. A company like Cisco Systems, they're trading at 12, 13, 14 price to earnings ratio multiples, which are still below the average multiple of the S&P 500, whereas the internet-based technology companies, take Twitter, for example, not generating earnings, $20 billion company. There's a perception that it's going to grow, but it's trading at a multiple of almost infinity. I mean, I think if you look at it on a screen, it's trading at 1,000 multiple.
And not justified by the actual earnings that it's making. I want to very quickly talk about the Fed's role in all of this. You know, the saying, sell in May and go away. We don't know what the Fed can be expected to do. What's your thought on that?
I think sell in May and go away historically has some merit to it. It's not clear to me that that's going to be, over the next couple of weeks, a strong sort of headwind for the market. The Fed clearly needs to provide some clarity as it relates to its future interest rate moves, if any. We think that it's going to be a slower and more gradual flight path for the Fed, that the sort of easing monetary policy while tightening is occurring will continue for quite some time. We think Europe is just starting with its quantitative easing policy, and Japan will continue. So we think this will be generally an incremental tailwind for equity markets over the medium to long term.
Okay. Thank you, as always, for your insights. Aaron Kennon, Chief Executive Officer at Clear Harbor Asset Management.